How hard is it to put together an Excel spreadsheet with the mysteries of this American economy?
Well, it's typically difficult, but it's become increasingly difficult with all of these ancillary factors that are coming in that are virtually impossible to model. We do have a lot of international factors that are impacting the market's expectations. We do have now unprecedented fiscal variables that we're trying to account for. But I think right now the market is very much discounting that third quarter number, focusing instead on the latest central bank decisions, the BOC, the ECB, as a proxy for what to expect from the Fed next week, suggesting that developed central banks around the world, despite still elevated inflation, are starting to pull back in anticipation of a slower level of longer-term growth. So the market very much anticipating the Fed may be moving to the sideline for certainly a prolonged period of time, but maybe indefinitely at this point.
So, Lindsey, just to crystallize what you're saying, are you saying that the Fed can kind of look through what we're getting out of this blowout GDP print, or at least that's the market's expectation?
No, that's the market's expectation. But remember, the market has been preemptively calling an end to Fed rate hikes for the past 2 years and wrongly pricing in rate cuts. The Fed, however, has been very clear, beating that drum of higher for longer, very consistent in their message. And I think when we look at some of the underlying data in the Q3 report, the resilience of businesses, the resilience of the consumer. And yes, to Lisa's point, we have seen a little bit of an uptick in claims, particularly continuing claims. But broadly speaking, the labor market is still extremely tight. So the Fed is looking at all of these data juxtaposed with inflation that's still too high. I think the committee is going to have a very difficult time selling a prolonged period of a pause. I think there is still more work to be done before they reach a sufficiently restrictive level to ensure that we remain on a disinflationary trend back to 2%.
Well, Lindsey, you're getting at what I've been wondering about. Of course, this is a very binary question, and we live in a shades of gray world. But when you think about the just raft of numbers that we got this morning, you take a look at the blowout GDP print, but then you look at initial jobless claims a little bit higher. What's the stronger signal there? Which one should we be focusing on?
Oh, the consumer, certainly. And I understand that this is backward looking. But remember, claims are extremely volatile, and we don't want to look at one data point, but rather the underlying trend in claims, which is still extremely low, still signaling that tight labor market or tight labor market conditions, which is going to continue to perpetuate the ability for upward pressure on wages, extending that to further purchasing power for the consumer in the marketplace, suggesting, again, the backbone of the economy, the underlying support of the economy, i.e. the consumer, remains resilient.
There's been a real angst underpinning some of the recent sell-off in the bond market at the longer end that hasn't been tied to the Fed at all. It's been tied to a widening deficit and likely increasing spending. How much is the Fed going to find itself increasingly at odds with fiscal spending? Because you talk about the need potentially for the Fed to do more. How much is the strength that we're seeing in the GDP preprint tied directly to that government spending?
Oh, absolutely. This is one of the problems. When monetary policy and fiscal policy are moving in opposite directions, that's going to force the Fed's hand to take an even firmer position to counteract that expansion of government outlays. Now, we do know that federal stimulus has largely concluded, but there's other fiscal stimulus that's coming down the pipeline as a result of legislation that was passed over the last 12 to 18 months, be that infrastructure spending, the IRA, the CHIPS Act, and other spatterings of state and local stimulus that is still being spent on constituents. So there is still a lot of purchasing power, a lot of borrowing and investment power out in the marketplace that the Fed is desperately trying to drain out of the system. But again, the more that we see monetary and fiscal policy moving in opposite directions, the more that becomes a barrier for the Fed to achieve its goal of price stability.